So this is the problem on cash discount. Sagar Company currently makes all sales on credit basis and offers no cash discount. It is considering offering 2% cash discount for payment within 10 days. So initially it is offering no discount and it is planning to offer 2% discount within 10 days. The firm's current average collection period is 60 days. Its sales are 2 lakh units at rupees 30. Variable cost is 20 rupees. Average cost is 25. It is expected that the change in credit term will increase sales up to 2,25,000 units. Average collection period will increase. And however, due to increased sales, increased working capital required would be 1 lakh. It doesn't take into account the effect on debtors. Assuming that 50% of total sales will be on cash discount and 20% is required rate of return, suggest the company about the proposed discount offer. So we'll start preparing income statement like we did for credit period. Similar way, only additional thing here is instead of bad debts, we will take discount here, and there is a formula to calculate discount which we have already done in the formula method. Same formula, this one we will use to calculate discount. So when we are calculating discount, we'll go through this formula as of now. We'll go to the tabular method and we will start solving. So we have two plans. As of now, the company offers no discount. See here. Currently makes all sales on credit basis and offers no cash discount. So this is the present policy, and then they are considering to offer 2% cash discount for payment within 10 days. This is the new policy. So there are two policies. We'll write it as existing and new. So as we start with sales always, we'll write as sales. Existing sales are 2 lakh units and the selling price is 30 per unit. So for existing, we'll do 2 lakh into 30. That comes to 60 lakhs. And new sales are 2,25,000 units. And the selling price remains the same, that is 30. So for new sales, 2,25,000 units into 30 selling price, we'll get 67,50,000 as sales. From this, you less variable cost. $2 lakh into, we'll see what is the variable cost per unit. Here it is given variable cost per unit is 20 rupees. So we'll do 2 lakh into 20, which comes to 40 lakhs. And for the new, 2,25,000 into 20, which comes to 45 lakhs. So this is variable cost. From sales, when we minus variable cost, we get contribution, which we call it as sales minus variable cost, S minus V. So 60 lakh minus 40 lakh is 20 lakh. And 67,50,000 minus 45 lakh is 22,50,000. So this is contribution. From this, next we will less the fixed cost. How much is the fixed cost? We'll see. Just see here. Selling price is 30, variable cost is 20, and the average cost is 25 per unit. So fixed cost will be, we have done this earlier also, from the average cost 25 rupees. Average cost 25 rupees, you minus the variable cost 20 rupees, and you will get the fixed cost 5 rupees per unit. Now fixed cost we calculate only on the existing sales, that is 2 lakh units, because fixed cost remains fixed. It will not increase with increase in sales. So whatever is the existing sales on 2 lakh, 5 rupees is what is our fixed cost. So on 2 lakh 5 rupees will be 10 lakh rupees. So this is about the fixed cost. Now we will do less discount. So we'll have to calculate discount. There are no bad debts in the problem, but there is discount in the problem. So we'll use this formula for calculating discount. Okay, delta discount is equals to PN. PN is nothing but proportion of new customers who will take the discount. So let's see here, they might have given it. Just check what's the proportion. See here, assuming that 50% of the total sales will be on cash discount. So that means 50% of the customers are ready to take cash discount. So here delta discount is equal to 50% means 0.5 into S naught plus delta S. S naught is the actual sales and delta S is the increased sales. So here if you could see, the existing sales is 60 lakh, the new sales is 67 lakh 50,000. So the increase is only 7 lakh 50,000. So it is as good as 60 lakh plus 7 lakh 50,000. We are taking that 67 lakh 50,000. In that 60 lakh is existing sales and 7 lakh 50,000 is the increased value. If you could see here, already if you do 2 lakh into 30, you already have 30 lakh, 60 lakh worth sales. Now only 25,000 extra are increasing. So the sales have become 67 lakh 50,000. So the difference between the two, that is 7 lakh 50,000, is the new sales or increased sales. So 60 lakh existing sales plus 7 lakh 50,000 new sales. That is delta S, additional or increased value. Okay, into new discount. Any doubts on how I took delta S?
No, ma'am.
So the discount rate is given here, offering 2% cash discount on payment within 10 days. This itself is your new discount. So we take the discount rate here 0.02, that is 2%. From this we have to minus the old proportion of customers taking discount. Now the first line itself says the company makes all sales on credit basis and offers no cash discount. That means earlier there was no discount given. When there was no discount given, that means 0 customers took discount because the company didn't give discount only. S naught is the old sales, which is 60 lakh. Into discount percentage is 0 because earlier company gave no discount. Discount has started now. Okay, so only the amount of sales is there, proportion and the percentage of discount is 0 because none of the customers has taken discount as company didn't give discount, and the discount rate was 0% because the company didn't give discount. So when we solve this, you get the answer of delta discount as 67,500. Okay, this side it will be full 0 into 60 lakh into 0 is 0. Only this part we solve and we get 67,500. Okay, so this is what is the discount value. We'll take it here. Discount in the earlier case existing was 0 and the new discount that is offered is 67,500. If earlier discount was given, then we would have used only this formula. This is the existing discount. So we would have taken this amount, and for new discount, we would have taken the minusing. Okay, so that was about discount. Next, we'll see. Okay, there is no other cost, so we will minus this and we will get profit before tax, which comes to 10 lakh. And 11,82,500. From 22 lakh 50,000, we minus 10 lakh 67,500. So we get 11 lakh 82,500. From this, we do less tax, which is 0 and 0. So profit after tax, same 10 lakh and 11 lakh 82,500. Now there is one more thing given here. If you could see, working capital required will be 1 lakh. So this is additional working capital. The cost of this also has to be taken into account. And the cost is given here, 20% is the required rate of return and 1 lakh is the additional working capital. So we will take it after profit after tax, we will say less cost of additional working capital. So 1 lakh is the additional working capital and 20% is the cost. So that comes to 20,000. Now remember, it is additional working capital. So we are not going to take it in existing. We are only going to take it in new, because only when we are doing the new sales, we are incurring this cost of additional working capital. Okay. Now there is one more thing that we have to less, that is cost of additional investments, for which we do working note. Okay, so here particulars, you can write here additional investment working note we are doing. Existing and new. To find the additional investment, the formula is cost divided by debtors turnover ratio. So first we'll find the debtors turnover ratio, and the formula is, for debtors turnover ratio, it is 360 divided by average collection period. Just a second. So 360 divided by average collection period. In the first case, the average collection period, the firm's current average collection period is 60 days. So you could see here, this is the average collection period in the first case. And then they have said the average collection period will fall to 45 days. So this is a new one. So old is 60 days, 60 divided by 360, and the new is 45 days. So 40 divided by 360. So you get 6 times here. And 45 divided by 360, you get 8 times. Now the formula is cost divided by debtors turnover ratio, or we also call it as variable cost plus fixed cost divided by debtors turnover ratio. So in this case, the variable cost is 40 lakh and fixed cost is 10 lakh. So 40 lakh plus 10 lakh divided by 6 times We'll get the debtors turnover ratio, or sorry, the delta I as 8,33,333.
Ma'am,
Yes.
ma'am, 360 divided by 60, no?
1 second. No? Yeah, I took it. 360 divided by 60 is equals to 6. And 360 divided by 45 is equals to 8. Correct. So it's 360 divided by 60. So this is what you get as delta I. For the new case, variable cost is 45 lakh and fixed cost is 10 lakh. So 45 lakh plus 10 lakh divided by 8 times the debtors turnover ratio, you get 6 lakh 87,500. Now the cost of additional investment is 20%. So first we'll do 8 lakh 33,333 into 20%. You get 1,66,667. And for the new plan, it is 6 lakh 87,500 into 20%. So you get 1,37,500. So here when you minus, you get the profit. So 10 lakh minus 1,66,667, you get 8,33,033 and 10,25,000. So if the company gives discount, the profit for the discount or the new scheme is 10,25,000, which is highest. So therefore the company should go for giving discount as the profit in the new scheme is more than the old scheme. Any doubts in the problem? Okay, now I don't know how many of you have observed, but when I do formula method, I add cost of additional investment. So here in the formula method, if you see, we had done plus here plus k into delta I. So we are adding additional investment. Whereas in the tabular method, I'm still doing less cost of additional investment. Reason being, in case of the first thing, we just find the cost of additional investment and we add it back. But here what we're doing, we are finding the cost of existing and we are finding the cost of new, both. And we have to less this. If you see, here it is more and here it is less. That means you're saving. When you give discount, your additional investment cost is coming down, you're saving. So indirectly, you are having less cost. That means your savings are getting considered. So here you need not add it. Here the format says less, you need to less it. Whichever method we do, credit standard, credit period, cash discount or collection efforts, you need to less the cost of additional investment. Any other doubts anybody has, you can clarify. Is that clear?
Yes, ma'am.
Yes, ma'am.
We'll do one more sum. A company currently has 10 lakh per annum of sales, all on credit terms of 60 days. The average credit taken is, however, 80 days. It is considering offering a discount of 3% within 7 days, and it expects 60% existing customers will take the discount. What I'll do is, here also it is like the similar problem. They don't give discount and now they've started giving discount. So I will add discount for existing. I'll change the question a little bit so that I can show you when both the discounts are there, how it will work. So company currently has 10 lakh per annum sales, all on credit terms of 60 days. with a cash discount of 1% within 10 days. Okay, so if the customer pays within 10 days, he will get 1% discount. This is there in the existing plan. And in the new plan, it is considering to give 3% discount within 7 days. And it is expecting 60% of the customers will take discount. So in the existing, we will assume 40% of customers will take discount. I have changed the question bit so that I can show you both the discount methods. The remainder will be equally split between those paying after 80 days and those paying after 100 days. Okay, the new credit terms are also expected to generate an additional sales of 50,000. Variable cost is 80% of sales and the company's bank overdraft cost is 14%. The company wishes to know whether offering discount is worthwhile if no new sales are obtained and if new sales are generated. Okay. So what we will do now here is, here I'll write existing, here we'll write no new sales, and here we will write new sales. So we have to do two options there. If you see, no new sales are obtained and new sales are obtained. So these are no new sales, and this is existing. Let's start. The company currently has rupees 10 lakh per annum of sales. So the sales amount we will take 10 lakh. Then when we give new discount and there are no new sales, that means the same sales we are taking 10 lakh. And then when we give discount and there are new sales. So what is the new sales amount given? They've said additional rupees 50,000 of sales. So the new sales amount is 50,000 in this case. So it will be 10 lakh 50,000. 10 lakh existing and the new sales that are getting added are 50,000. Are you understanding the logic? Here this is existing. This is no new sales, but we are giving more discount. And here we are giving more discount and we are having new sales also. So three options we are solving for. From this we will do less variable cost. So variable cost they have told is 80% of the selling price. So 80% of 10 lakh. We write into bracket 80% of sales. 80% of 10 lakh is 8 lakh. Then next is again 8 lakh. And 10 lakh 50,000, 80% is 8 lakh 40,000. So when we do sales minus variable cost, we get the contribution. Is 2 lakh 2 lakh and 2 lakh 10,000. Okay. Now we'll see what is the fixed cost given. If they mention anything about fixed cost anywhere, we'll just check it. Okay. Company currently has 10 lakh 60 days with a cash discount. The average credit taken is 80 days. It is considering offering a discount of 3% within 7 days. No, they have not mentioned about fixed cost anywhere. So we don't have the value of fixed cost. So fixed cost, we'll write it. Less fixed cost as 0, 0. Now we have to do less discount. So for discount, first what we will do is, we will calculate discount for existing. So for existing, we don't need delta discount, we need the total discount, which we will get by doing this. P naught into S naught into D naught. So the present proportion of sales, P naught, which is given here, 40% of the customers will take discount. So 0.4 into S naught, the existing sales, which is 10 lakh rupees, into D naught, that is existing discount, which is 1%. 0.01. So we need to multiply this. You get it as 4,000, right? So this is your existing discount, 4,000. Here I will write it. Now we'll find discount for plan 1 when there are no new sales. So here, this I'm writing as 1. I'm doing it for, okay. So we'll write delta discount is equals to proportion of customers taking discount. So now here the new proportion is 60%. So 60% of customers are taking discount, 0.6 into bracket S naught plus delta S. S naught is 10 lakh plus delta S is 0 here because we are assuming no new sales. I'm doing it for this. No new sales are obtained, the first point. So in first point, the new sales are 0. Then the new discount that you're going to give is 3%. So 3% is the new discount into 0.03 minus P naught, S naught and B naught, which is nothing but 0.4 into 10 lakh into 0.01. Okay, so we'll calculate now. 60% of 10 lakh is 6 lakh into 0.03 is 18,000 minus 4,000, that is the existing sales. So you get the new discount as 14,000. When you calculate this, you get 4,000, right? Has anybody done?
Ma'am, I'm getting 18,000.
18,000 minus this 4,000, right?
Yes, ma'am.
Yes, ma'am. 14,000 is correct, ma'am.
Let's do it for the second plan now. Then you have new sales. delta discount is equals to proportion of new customers, that is 0.6 into 10 lakh existing sales plus the new sales that they have told is 50,000. So 50,000 into 0.03, the new discount, minus the same P0, S0 and D0. Now we need 60% of 10 lakh 50,000, which is 6 lakh 30,000 into 0.03, which comes to 18,900 minus 4,000 old discount. So it comes to 14,900. Just check, I hope all are getting it. So these are the three discounts. So if you see, for the existing one, I took only the existing portion. Remember this, the existing one, there is no additional discount, delta discount, it is existing discount. So old proportion, old sales and old discount rate, and you get it. For the new one, you have to do new minus old to get the additional amount. Okay. So if you less discount, you will get profit before tax. So 2 lakh minus 4,000, you get 1 lakh 96,000. 2 lakh minus 14,000. 1 lakh 86,000. And 2 lakh 10,000. Minus 14,900. 1 lakh 95,100. Then less tax. No tax rate is given. So you get profit after tax. The same amounts. Now we'll find the cost of additional investment, for which we need the debtors turnover ratio, and they have asked you to assume 365 days in a year. So I'm taking 365 divided by ACP. Just look at the question. They have asked, specifically mentioned, assume 365 days in a year. So I'm taking 365. In the existing case, the average collection period is 60 days. Sorry. The average credit taken here, this we have to take, not the 60 days. Average credit taken or the average credit period 80 days, and for the new we will take 100 days. So existing we are taking 80 days, 365 divided by 80. For new we are taking 100 days, 365 divided by 100 and 365 divided by 100. So 0.56 you get when you do 365 divided by 80. 4.56 times. Then 365 divided by 100. 3.65 times. And here also to be 3.65 times. Now we'll find the delta I, that is additional investment, variable cost plus fixed cost. Fixed cost is not given, so we'll take only the variable cost, which is 8 lakh divided by 4.56. Then again 8 lakh divided by 3.65. And in the third case, variable cost is 8,40,000 divided by 3.65. 8 lakh divided by 4.56, you get 1,75,438. 438.5, so we'll take it 439. Then 8 lakh divided by 3.65, you get 2,19,178. And 8,40,000 divided by 3.65, you get 2,30,137. Now we'll less cost of additional investment. So 1,75,439 into, see here they've given bank overdraft cost is 14%. So this 14% is your cost of additional investment. So into 14 divided by 100. You get 24,561. Next, 2,19,178 into 14%. $30,685. In the third case, 2,30,137 into 14%. $32,219. So here profit 1,96,000 minus 24,561, 1,71,439. Unlike 86,000 minus 30,685, you get 1,55,315. 1,95,100 minus 32,219, 1,62,881. So which one will you choose for? Yes, anybody?
Existing, ma'am.
Existing, because the profit is highest here. Okay, so existing you will choose. I changed the question, I gave discount in existing, so all this is happening. If I wouldn't have changed the question, maybe no new sales or new sales would have got selected, because the discount rates and all would have changed. Okay, so this is how you'll have to solve the problem when discount is given, and this is how you'll have to make decision. So we would say the company should not give additional discount because the profits are not increasing, instead they're decreasing. The existing profit is highest, whereas the other profits are comparatively low. Okay, so this was about cash discount. Now we'll do the next sum, which is on collection effort. Okay, so G Limited has an annual sales of rupees 24 lakhs. The selling price per unit is 10 and the variable cost is 70% of selling price. The required rate of return is 20%. Average cost is 9. Annual collection expenditure is 50,000 and current percentage of default, nothing but bad debts, is 3%. Credit term allowed by the firm is 2 months. So as of now, company is giving them 2 months period. G Limited is considering to change the credit policy by following the option A or option B. So they've given the details about option A and B. In option A, the firm is planning to give 1.5 months credit, and in option B, 1 month credit. Whereas annual collection expenditure will be 75,000 and 1,50,000. And the percentage of default will be 2% and 1%. Now this problem is little different from the usual one. Can anybody tell me what difference you will find in this? What was the existing credit term? 2 months. What is the new credit term that is being given? 1.5 and 1 month. So what is happening, instead of increase in credit period, they are decreasing the credit period. That means they are making strict credit policies. They don't want to give more time for payment. They're saying earlier we used to give you 2 months to pay the money. Now you pay in 1.5 months or you pay in 1 month. So they are not liberalizing their credit policies. They are not becoming lenient, but they are becoming strict, and they want to collect the money early. So because of this, their collection efforts are increasing. So here you see there is a collection expenditure. They're already spending 50,000 rupees when they give 2 months credit. When they give 1.5 and 1 month credit, they'll have to spend more on the collection efforts. The method of solving the same sum is exactly same like credit period and credit standard or cash discount. There will be no major difference. But here, when we talk of collection effort, they usually try to collect the money early. So if I was giving 2 months credit, now I want to give 1.5 months and see. Then I want to give 1 month and see. So they are asking which policy is better. Should I go with my existing 2 months only, or can I be little strict and I can give only 1.5 month credit, or a little more strict and give 1 month credit? So we have to tell which is better for the company. So same way, tabular way we will solve, and we'll have 3 choices. So we'll call it as existing, option A and B. There are 2 options given, A and B. So existing is better or A and B are better, we have to find. All of you are getting it? Any doubts still here? Anybody, any doubts?
No, ma'am.
G Limited has annual sales of rupees 24 lakhs. So sales 24 lakhs. The selling price per unit is 10 rupees. Variable cost is 70% of selling price. The required rate of return is 20%. Average cost is 9. Okay, they've given you the collection efforts. Okay. They have not told you that the sales will increase or decrease. So we will take sales as same for all the three options, because when we saw the options here, they have not mentioned anything about sales. They've only spoken of average collection period, annual expenditure, and percentage of default. So nothing is happening to sales when we do this. So sales are going to remain same, 24 lakhs. Okay, then they're saying variable cost is 70% of selling price. So we will write here less variable cost into bracket 70% of selling price or 70% of sales. So of 24 lakh, 70% is 16 lakh 80,000. Next, we get the contribution. Sales minus variable cost is the contribution, which comes to 7 lakh 20,000. Then we'll do less fixed cost. Fixed cost is not given in the problem directly, but we need to find it. Okay, so here they have given you writing working note on fixed cost. They've given you selling price, which is equal to 10 rupees. Then they say variable cost is 70% of selling price, which will be 70% of 10 rupees. So 10 into 0.7 if I do, I'll get 7 rupees. And then they've given you average cost, which is 9 rupees. So we have to find the fixed cost. So average cost equal to 9 rupees. From this I'll minus variable cost, which is equal to 7 rupees. So I will get fixed cost. So 9 minus 7, how much you get? 2 rupees. 2 rupees is fixed cost per unit. Now we don't know the number of units also here, because they have just said the annual sales is rupees 24 lakhs. So we have to find the number of units. Annual sales is 24 lakhs divided by selling price per unit, which is 10 rupees. So if I do 24 lakh divided by 10 rupees per unit, my sales will be 2,40,000 rupees. Okay, so now I know that I have 2,40,000 units and my fixed cost is 2 rupees per unit. So 2,40,000 into 2 if I do, I'll get the fixed cost, and fixed cost will not change with the change in sales. So it will remain same for all the three options, 2,40,000 into 2 rupees, which comes to 4,80,000. Then we have another cost, less cost of collection. We mentioned it as collection expenditure, or you can just write less collection expenditure. Okay, collection expenditure for existing, it is 50,000. For policy A 75 and for policy B 1,50,000. So 50,000 for existing, 75,000 for A, and 1,50,000 for policy B. So when we minus this, we get profit. Sorry, there is one more thing they've told about bad debts. So we do less bad debts. Now, bad debts, what they have told, existing default percentage is 3%, and the new they are telling is 2 and 1%. So on sales we take bad debts. So we will write here sales is 24 lakhs into existing bad debts is 3%. So 3 divided by 100. 3% of 24 lakhs is 72,000. Then 24 lakhs, again the same sales into, for policy A, the bad debt was 2%, so 2 divided by 100, 2% would be 48,000. And in the last case, the sales is same, that is 24 lakhs. The bad debt percentage is 1%. So that comes to 24,000. So these are the cost of bad debts which we need to consider. Okay, now we'll minus all these three from contribution, fixed cost, collection expenditure, and bad debts to get the profit before tax. So 7,20,000 minus all three when I do, I get 1,18,000. 1,17,000. And 66,000. From this we do less tax, which is not given. We get profit after tax. Then we do less cost of additional investment. For which we have to find the additional investment. Here they are not told to consider 365 days in a year. So we take our original formula, 360 divided by average collection period. Average collection period is nothing but this 2 months, 1.5 month and 1 month. So 2 months means 360 divided by 60 days. In 1 month 30 days. So 2 months it will be 60 days. So we will get it as 6 times. 1.5 months means 360 divided by 45 days. 30 days in 1 month and 15 days in half month. So 360 divided by 45 you will get it as 8 times. And 360 divided by 30, because in the third case it is 1 month, so you get it as 12 times. Now variable cost plus fixed cost divided by debtors turnover ratio is the formula. So variable cost is 16,80,000 and fixed cost is 4,80,000. Same in all the three cases. So 16,80,000 plus 4,80,000 divided by 6 times here is same. Here it is divided by 8 times and divided by 12 times. So you get additional investment as 3,60,000. Two lakh 70,000 and 1,80,000. So this is additional investment. We have to find the cost of additional investment. The cost percentage, just see if they have given here. %, yes. The required rate of return is 20%. So this is the cost that is given. So 1,18,000. Sorry, we have to take the additional investment, that is 3,60,000. Into 20%. Then 2,70,000 into 20%. In the third case, 1,80,000 into 20%. So you get 72,000, 54,000, 36,000. When we less it, we get the profit. One lakh 18,000 minus 72,000. If I do, the profit is 46,000, 63,000, then 30,000. Okay, so which option is better? Option A is better because we have 63,000 profit, which is higher than the existing plan and the option B. So that means the company should go for giving 1.5 months credit as it gives more profit compared to 2 months and 1 month credit. So this is how the problems on collection efforts are to be done. If you saw the entire problem, the only difference is this: they gave you collection expenditure. Whereas in other problems, they didn't had anything called as collection expenditure. So it is same like credit period problem, and there's only one sum that I'm doing on this because it is similar to credit period and there are no more sums on this. Okay. Now the next part of the problems that I have are again related to credit period and credit standard with a little bit of difference. You take a